Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Hello, everybody. I'm Thane Stenner, founder of Stenner Wealth Partners of CG Wealth Management, and very pleased to have everybody listen in today and with my special guest. So I'm the host of the BNN Bloomberg Smart Wealth monthly podcast, which seems to be catching a lot of attention these days with the guests that I am privileged to have on. And it's quite interesting for me to have a lot of the different leaders, pioneers, thought perspectives of some pretty bright and leading edge people in different categories attend as a guest on my podcast. So I'm super excited about today's session. My special guest today is a three-peat guest, actually, Ben Rabidoux. So welcome, Ben.
Thank you, Thane. Good to see you again.
Likewise, after a long weekend here in Canada. And he's the founder of North Cove Advisors, which is a boutique research firm in Canada, which is consistently ranked in the top 5 for independent Canadian economic research. So very, very pleased to have Ben on again today. His past guesting sessions with me and for us have been extremely insightful. And I think not only insightful, but actually very accurate in most circumstances around some of the things that he was observing, his group's observing as to what's going on, boots on the ground here in the Canadian economy. So with that in mind, again, welcome, Ben. Thanks for taking the time out of your busy schedule. And let's get started, shall we?
Let's do it.
Okay, so I've got this should be a pretty freewheeling session, given the fact we've interviewed with each other before, and I've kind of know your research quite a bit as your latest thoughts are very insightful. So let's get started with this last year. How would you say you've been surprised? Like what surprised you the most as to what's going on in the Canadian economy over the last 12 months?
Yeah, well, there's a lot we could talk about. I guess I'll focus in specifically on kind of housing because that is my main wheelhouse. As it relates to housing, I think a couple things surprised me. The first is that until really the last month and a half or so, we've been surprised at how low inventory levels have been, even in spite of very high rates. So for example, today across the country, we're still sitting at inventory levels that are about 30% below decade norms. And that's 2 years into a rate hiking cycle. So that's been a bit surprising. On the flip side, I would say the demand coming into the spring selling season has been softer than I expected. And so you kind of have these competing forces. Like I was writing late last year that I thought we would see a pretty decent uptick in sales. And I'm talking about seasonally adjusted sales. We all understand that sales always tick up in the spring. I mean, once you adjust for that normal seasonality, we would see a decent spring, not as good as last year, but the fact that we've got some signaling from the Bank of Canada that, we're getting closer to the time where they can start contemplating rate cuts, I would have thought you'd start to see some confidence coming back in the market. And I've been surprised at just how soft demand has been. And so on balance, I think real estate has been softer than I thought this spring. But it's certainly, it's not a disaster. It's just kind of like a squishy market where in most metros, you kind of got a sideways chop in pricing. So the big Southern Ontario metros kind of keep drifting lower, and then Alberta keeps looking great. So you've got this divergent trend. So that's kind of been a bit interesting to me. In terms of like the broader Canadian economy, I guess I'm still surprised at how resilient the consumer has been in the face of these high rates. Like we're still sitting today at a mortgage delinquency rate that's 17 basis points, like half of the long-term average. Like that's surprising. We have managed to skirt a recession in spite of the fact that we're one of the most levered consumer economies on the planet, and we've seen the steepest rate hike cycle in 30 years. I mean, I would have thought something would have broken by now. I don't believe we have dodged that bullet. I just think that everyone, myself included, underestimated the magnitude of the pent-up savings. that's managed to cushion households from some of that. And I think we're getting to the point where that's going to start to matter. I actually think it's fairly imminent. I've kind of had a view that by the end of this summer, but from what I'm seeing, we're beginning to see some pretty clear cracks. We just came off of a weird labor force survey print where, it was reported that Canada created 90,000 jobs. I mean, I'm gonna call on that. I don't know if I can say that on this podcast. So I'll call BS on that.
Yeah.
But you look at other indicators like the payroll data, which is a little more reliable. So you're not phoning people. It's not a household survey. It's drawing from official payrolls, and that data has been very soft. We're seeing private sector payroll start to really roll over, seeing business insolvency start to really mount. All of it to me suggests that we're getting close to the point where the tipping in the economy is going to become very evident. And I think, it's always tricky putting like a hard timing on these things because the economy is so dynamic and it's so hard to nail timing specifically. But man, I think we're close to the economy really starting to wobble. And I wouldn't be surprised if by the end of the summer, it's becoming patently clear that these rates are starting to break things. So, but all that said, I've been surprised that it has not happened yet.
Gotcha. So, in that scenario, let's just kind of go there. Obviously, that would imply that the Bank of Canada would then need to start to lower interest rates if it was becoming patently obvious. Would you agree?
Yeah, I do. And I know, looking at how markets are pricing in the Bank of Canada target rate going forward, it looks like June is kind of a coin toss, a little less than a coin toss. Looks like July is probably a lock, and they're looking like only 50 basis points of cuts by the end of the year. I'm just telling you, I don't think that's right. I think that probably what's going to end up happening, if I'm right, and the economy starts to really feel this, I think there's a lot more rate cuts that are going to be needed to put a floor under things. The one thing with the economy is once it starts to cool, there's just so much forward momentum that once things start to cool, they generally tend to cool quicker and for longer than people realize. Once that it's like trying to turn a ship. And generally, like little 25 basis point cuts over the course of a year, they don't move the needle. And so I think what will end up happening is, I think by the end of the year, we're going to have discussions around whether 25 basis point cuts at a time are going to be enough to put a floor under things. I think that the economy is really about to cool materially. And so I would certainly bet that we'll see more rate cuts than the market's expecting. And I thought that we'd probably start seeing those in size at the end of the year. And maybe that's pushed out and we start seeing them more in Q1 next year. But I think the market's just underestimating how quickly the economy is cooling.
Gotcha. So let's just extend the time period a little bit. So you kind of commented there, and quite candidly, I would agree with you based upon the research we're looking at from various sources. I think that's a pretty good assumption that you're making there, Ben, by end of 2024. But if we extend it out to the end of 2025, what are we talking about here? What would be kind of what you think would be the minimum cuts between now and the end of 2025? And in a hard landing scenario, what would you think the amount of rate cuts in cumulative fashion would look like in the next 18 months? 20 months.
Yeah, so I'll tell you what I'm wrestling with right now is I'm getting more and more conviction that the economy is cooling quicker than people realize, and I have a very strong conviction that the Bank of Canada is going to have to cut more than the market expects. Where I struggle is I'm also very convinced that Canada and the U.S. have never been at such a divergence in terms of their normal economic cycles. There's a lot of things we could look at. You look at per capita GDP growth. The U.S. just keeps churning out these monster prints. Canada keeps printing negative, right? You look at household debt service ratios. The U.S. is at basically all-time lows. They're just not feeling the impact of these higher rates. Canada's sitting at all-time highs. And so what that implies is, like, the Bank of Canada is going to want to cut. They're going to need to cut. I think, it's again, looking forward beyond the next, let's say, year, I think the conversation is going to end up being how far the Bank of Canada can cut if the Federal Reserve stays as hawkish, as tight as they are currently. And so I think they're going to be constrained at how low they can ultimately go. I wouldn't be surprised if we see the overnight rate kind of stabilize around 2.5 or 3. So call it 200 basis points of cuts. If the U.S. Federal Reserve doesn't start to cut, I don't think they can move much beyond that. I certainly don't see a scenario where we're going back to zero. And that's that's a discussion I think towards the back half of next year is how low they can go without really causing damage to the Canadian dollar if the Federal Reserve doesn't also start to ease their kind of, I don't want to call it hawkish stuff. They need to start getting much more dovish. Otherwise, we'll see the Canadian dollar really get pounded.
So let's go there, because that's something that seems to be a hot point these days too, is Canadian dollar roughly 73 cents roughly per US dollar today as we speak. So where do you think the Canadian dollar may end up going here the next 18 months if things play out the way that you're seeing?
Well, I don't know if it's going to be within the next 18 months, but I do feel that there's a very high probability that we will retest the lows of the early 2000s, where the Canadian dollar was in the low 60s. At some point this cycle, whether that's in the next 18 months, is up for debate. But I think the direction is it's going to be lower. And I think we're going to get down towards some of those all-time lows, just simply as a function of the fact that we've never seen the economies in Canada and the U.S. as divergent, and as the divergence, not even the right word, the interest rate sensitivity of the Canadian economy vis-a-vis the U.S. economy has never been wider. I guess that's the way to frame it. We have much more sensitivity to high rates relative to the U.S. So there's a number of reasons for that. The big one being that U.S. households delevered following the financial crisis, right? Yep. They paid down debt. They also defaulted on a lot of debt, so it just disappeared off their balance sheets. They wrote it off, and also they've termed out their mortgage. So you have 30-year fixed rate mortgages in the U.S. There's just no exposure to high rates, and you look at the business side. They have a much lower incidence of floating rate debt on the corporate side relative to other countries, including Canada. So I just, it's hard to see a scenario where the U.S. economy starts to weaken before Canada's starts to weaken, and frankly, before Canada really starts to fall out of bed. I just think there's just so much rate sensitivity here that's just not there in the U.S.
So let's play this out a little bit more. If the Canadian dollar does decline, which again, we're in the same camp there. Currently, we're about 74% U.S. dollar in our exposures on our portfolios for clients. So we have made that considered bet or allocation accordingly to try to protect client portfolios that way. If the Canadian dollar does drop into the 60s over the course of the next 1 to 2 years kind of thing, is that not also inflationary?
Yeah, it will be. I mean, it does risk that, right? And so there's ultimately a point at which they begin to import inflation, right? Just via higher import costs on anything that we buy abroad. And so, but again, that's a consideration. I mean, now you're talking a consideration out into like 2026, right? Like, So my point would be, as I think about kind of an order of operations, and again, once you start thinking this far out, the chance that you're going to be bang on is really low, because forecasting the next month in economics is so hard. But let's just play this game. So if I were to sketch out the most likely kind of the path going forward, is that we kind of have this oh crap moment later this summer, and it becomes obvious that the economy is much softer than people realize, that these rates just do not work. The Bank of Canada starts cutting. They cut well into 2025 and well ahead of the U.S. Fed. We see the Canadian dollar respond, but ultimately, I don't know if it's mid next year or beyond, there comes a point where they start to desync too much from the Fed, and then the conversation has to pivot to how low they can go before they begin to risk an inflationary bout from weaker currency.
Yep.
And that to me feels like more of a late next year, early 2025 type story. But again, or an early 26 type story. But that's there's a lot of steps between now and there, but I could see that being a plausible kind of roadmap going forward.
Let's pause there just for a moment. Stay with us.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth Podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Thanks for staying with us. We're back with our special guest, Ben Rabidoux. As far as North Cove Research goes, I mean, it's a boutique research firm, obviously. How long have you, let's just go back high level here. How long has your group been in existence, kind of focusing on research specifically?
2012.
Gotcha.
So call it 12 years. We're
Yep.
mostly kind of Canadian macro focused, a lot of focus on the things that the Bank of Canada's focused on, right? So housing, household credit, population growth, all those things. We've generally done pretty good work on all of that.
Yeah, and most of your research is probably purchased via institutions, I would guess, or family offices.
Yeah, mostly institutions. So my client base would be, half Canadian, typically kind of long-only entities, pensions, mutual fund companies, and then the remainder would be kind of global macro, long-short equity type funds. Have different focus on their research.
Yeah, understood. So part of your research talks about or shows refinancing of mortgages on the residential real estate side, 2024, 25, 26, 27. So are we quite close to a lot of that being reset higher?
Well, actually, surprisingly, we're at the point now where only about half of mortgages in Canada have seen any increase whatsoever in payments. This is only starting, and the big years. If you look at the originations, we had a huge surge in originations in 2020, 2021, early 2022, and that coincided with this period where rates hit. I mean, there were times where you could get a variable rate mortgage for less than 1%, right? Like, I mean, it was a crazy time.
Yep.
And so you can see this monstrous origination boom right around that period, 2021 to early 22, late 20 to early 2022. And so if you kind of roll that forward and you look at what that means for renewals, we have a fairly light year this year. Only about 15% of the mortgage stock is going to roll over in 2024. And then it jumps to 23% in 2025. And then 2026 is the big one. And almost a third of the mortgages are going to roll and renew in 2026.
Mm.
And what's really interesting is if you then overlay on that the median projected increase in mortgage payments at renewal. And this is data from the Bank of Canada. They've gone down this rabbit hole. And so median across all borrowers, come 2026, you're going to see about a 32% increase in payments. But the cohort that's most vulnerable are these, what we call static payment variable. So these are these variable rate mortgages where the payments don't actually change. So as rates go up, payment stays the same. You just pay off less and less interest.
And therefore,
less and less principal.
Yeah,
right?
and so therefore the amortization extends.
It blows out to infinity in some cases. They are negatively amortizing in some cases.
Wow.
And so when those renew, you have this kind of double shock where the rates reset, but then the amortization has to reset back to the original contract. And so now you're amortizing a larger balance over a shorter period of time. And so for that cohort, come 2025, next year, you're going to see over a 50% median increase in payments. And at 26, it jumps to 60%. And that's not a small cohort. My work shows that cohort's about 22% of all mortgage debt outstanding. So think about this, 22% of mortgage debt outstanding is facing a 50 to 60% increase in monthly payments come 25, 26. That's a real pickle if you're the Bank of Canada. That just reinforces my view that these rates do not work, right? We've got to get rates lower. There's going to be a real problem for that cohort, I think.
Well, and we're just speaking about the real estate side of things and the household side of things, but even from the government debt perspective, there's an article today, I think, in National Post, the Globe and Mail, talking about how the government didn't, their average debt that they rolled over during COVID was roughly 3 years in length instead of extending. You mentioned Mexico earlier, which we'll get to. But basically, Mexico kind of, their average duration of their debt right now is around 19 years. So they've, some countries extended term on their debt, locked in low rates. Canada didn't. So, from a government point of view, provincially point of view, our rates are going to be reset at a higher rate as well. So how would you describe this phenomenon, Ben? Is this like a debt wall, a refinance wall, in essence, coming at us? How would you describe this to the layperson?
Well, it is a debt wall. Now, look, there's different ways you could look at this, right? So an optimist who's looking at this would say, well, look, we can look at the mortgages that are variable rate with variable payments. So the ones where the payments have already reset. And so there you can look at, like, that's generally, the Bank of Nova Scotia, National Bank, those lenders have those true floating payment mortgages. And, there's not enormous stress there yet. I mean, you're seeing marginally higher delinquencies, especially in the early stage buckets, than the other big banks, but it's not alarming. So someone who's more constructive would point to that dynamic and also say that, yeah, look, you're going to 60% increase in payments, but maybe, incomes have got up 20% in the interim. And you know what I mean? So that's what the optimist would say. But I still struggle with this not getting vented out through much weaker discretionary spending. And so this ultimately ends up being just a big drag on consumption and then ultimately on economic growth broadly. And I don't believe for a moment that we have dodged what I think is going to be an imminent credit cycle and a much higher mortgage delinquency rate, for example. Like we talked earlier, like 17 basis points is where we're sitting today. That's half of the long-term average for mortgage delinquencies. Yeah. It has to double from here, just get back to normal. Like, are we going to overshoot normal in a higher rate? Of course we will. So it's probably going to triple from here, I think, at a minimum. So that's where we're going. And I think people just, and myself included, we always underestimate how long these things take, right? Yeah. People are very good at treading water for a period of time, at keeping fingers in the dam. And it's always surprising how long people can kind of tread, but it's not infinite, right? These rates are ultimately going to matter.
Yep, and it affects cash flow of the household consumer and balance sheet. So, so you just touched upon something there. So, share with our viewers kind of the waterfall when it comes to credit. Like, so obviously, mortgages on homes are the things that people try to pay the most of, right? They're living in their homes, but just start where stresses start to show in the credit continuum, because I know you do some really good research in that area as well.
Sure. Well, I think there's a few things that we look at. So you're right. When you think of kind of an order of operations, no one just wakes up one day and defaults on a mortgage. It's never like that.
Right.
So there's a natural order of operations. The first is generally you see in aggregate. We're going to talk at the aggregate level, right? Sure. So nationally, the things you're going to look for. The first is you're going to see a drawdown in savings, right? That's the first thing. And we have seen that. There's a number of metrics you can look at. Deposits at chartered banks, that's starting to slow. You're seeing some signs that there's at the margin some savings, particularly on the middle income group. Okay, the high income group always has savings. Lowest income group never has savings. It's the middle ones that drive the incremental changes. Mm-hmm. And for that cohort, you are seeing a trend towards savings. That's step one. Step two then is you start to see a contraction in discretionary spending. And so there you can look at, like, okay, pick on a couple of retailers like the Canadian Tires of the world, the Leon's Furniture, and look at their trend in same store sales. And so we're beginning to see that weakness show up. And even in Canadian Tire, they've commented specifically on it being driven by the discretionary bucket. Okay, so consumers are tightening their belt. That's step two. Step three then is you start to see rising delinquencies in things like credit cards and autos. And that we're seeing more so in autos, although credit cards starting to really move too. You see declining payment rates, for example, in credit cards. That's a leading indicator. You're seeing rising delinquencies, rising charge-offs. All of those are there in the credit card trust that we follow. And then after a period of time, and it takes a while even after you see that, then it starts to show up materially in the mortgages. And so I would say if you consider that like a 9-inning game where inning 9 is you get a material move in mortgage delinquencies, we're probably inning 7. Like, we're very close to that. Now, what we generally need to see a real material increase in delinquencies, you do need job losses. And again, I think that the labor market data is, it's just muddy right now because you've got the labor force survey. We just came off this kind of crazy 90,000 print that doesn't really make a lot of sense. But the other indicators are showing much softer trends in the labor force. And I think to me, that's the better signal. And so, I still think that we're months away from seeing a material move in mortgage delinquencies.
So is one of the things you look for is where the slope of the data starts to accelerate?
Yeah, I mean, we're seeing that. If you look at, so you got to be careful, right? Because there's also like an issue with just how timely the data is. So what I'm referencing when I look at mortgage delinquencies, like that's Canadian Banker Association data.
Yep.
And there it's tricky because, we're only now getting data from, I think we're getting like February data. Like it's so badly lagged. And then that is still like, 90-day minimum. In some cases, it's 180 days missed payments. So like you're catching people who stopped making their mortgage payments last year, like Q3 last year in some cases. And so, it takes a while for that official data to show up.
Gotcha. So some bank research we saw here in the last week talked about loan loss provisions going up at the banks. Any surprises there from your point of view?
No, I mean, I thought they were going to go up there. I still think they're going to go up. If anything, I think the thing that is not being reflected yet is the issues in the construction space. And some of these big developments, condo developments that are going to be, I think, potentially very problematic for these banks going forward, just because you got to get a little inside the weeds on this. But one of the things, if you want to get kind of a little scary around housing, is the trends in pre-construction condos in Toronto, for example. Vancouver's the same, but Toronto's kind of the epicenter. And so to boil it down really succinctly, people paid a premium to purchase a condo that won't be delivered for 4 or 5 years. Okay, so they bought the units being delivered today were bought originally in, let's say, 2019, just to simplify things. And in the pre-construction space, developers realized that there was so much froth and so much speculation that they could price in a premium to buy a unit that hasn't even been built yet, relative to a new unit that's sitting unoccupied that's just been completed across the street. So you might be paying $1,600 a square foot pre-construction. You can walk across the street and buy that one for $1,200, which is a little bit crazy. But now we're at the point where the resale market is flattening out. It's falling for condos. And so this gap between what people paid pre-construction and the actual resale value, it keeps widening. And so now you're at the point where you've got developments that are 20 to 30% offside. In other words, people have contracted. They basically said, well, we will buy this when it's completed for $1,500 a square foot, but resale comparables are like $1,100 a square foot. And that only gets worse as you get into 25, 26. That gap gets much wider. And so the question is, who closes on that, right? If I'm a buyer and I purchased pre-construction back in 2019, it's closing today, but I'm offside and my deposit is gone and I still owe, you know what I mean? Like,
yeah,
who's going to buy that? And you run the risk of people starting to walk away. It gets really ugly. We've never seen that dynamic. I don't know exactly how it's going to play out, but I can certainly see a scenario where OSFI is going to start looking at that and being like, geez, guys, you get a lot of exposure to this. Why don't you start provisioning a little more heavily? Because we don't know how this is going to play out, but there's a good chance it's not going to be good.
Yeah, well said. So how do you think the federal government's looking at this right now versus where the Bank of Canada, what they're saying versus really what they're thinking? I know I'm asking you to be a little bit of a closet psychologist here for a moment. Obviously,
I push back on the fact you used federal government and thinking in the same sentence, and I would push back and like that's right off the bat, that sentence doesn't make sense.
Fair enough. Okay, so what do you think's in their playbook then what are they going to try to do to combat a slowing economy aside from interest rates?
Well, I mean, I think they're in a real pickle. So if you look at, if you assume that the government's going to do whatever they can to try to get reelected, so then you look at, well, what is causing the issues in the polls for them? And it's really around housing and cost of living.
Yep.
Right? And cost of living is a derivative of housing. The affordability, high rents. And so it's an interesting dynamic where the solution to all of that is a cooler economy. The solution to that is high rates.
Correct.
So if you're this government, like you're in a real pickle because you're stuck between having to choose with allowing the housing market to stay unaffordable, allowing rents to stay very high, versus cooling things and having to accept job losses, right? You're kind of screwed either way.
it's kind of the wealth effect versus the hard effect, right? If things actually really hitting more of a hard landing versus a soft landing.
Yeah, but the soft landing, I would say, has to involve, it has to be inflationary, right? If they're going to pull off a quote unquote soft landing, like in other words, the solution for the government to all the issues that they're getting hammered on in the polls is to allow rates to stay higher, allow the economy to cool, allow some job losses, and so that inflation comes down. But doing that means you're dealing with now a bunch of grumpy people because, job market prospects aren't what they used to be.
Yep.
It's a real pickle. So like, I don't know which one they're going to choose, but doing nothing, it just means they keep getting hammered in the polls. So they're going to have to do something. And
Yeah.
I don't know. I'm not smart enough to figure out what they're thinking in Ottawa, those bunch of jokers.
Yeah. So let's talk about nationally then. Who's positioned better? Let's just say better versus well, versus which province is probably positioned the worst currently from a real estate.
Yeah. So certainly Ontario looks very exposed. And conversely, I've said for a while, like if there was a way to, I said like 3 or 4 years ago, I was saying if you could be long Alberta and short Ontario, it'd be just a layup trade because I think Alberta had so much going for it. And I mean, it's easy to say now because but go back to 2020, 2021, when everyone was talking about the death of oil and EVs are going to eat the world and Alberta's going to be stuck with all these, these unproductive assets. And to me, like that is an easy call to make in hindsight. But at the time I said that we're going to see a massive catch-up trade where Calgary house prices are going to go from trading at a record discount to national averages to going back above the national average. And that was a crazy prediction at the time, but we're way on the way. We're seeing like there's been 25 percentage points of outperformance in Calgary house price over the last few years. It hasn't. That's not going to stop anytime soon. There's so much positive momentum in that economy. I think this goes for a little while longer, and at the same time, I think that just we're only starting to see the adjustment here in Ontario. Prices are down, and in fact, you always got to be careful being bearish something that's moved a lot already because we've got some metros in Ontario that have seen 30% declines in real terms off of the highs, right? So like London and Kitchener have seen 30% declines. For example, Toronto's not far behind, 26 or whatever. Like those are real moves. That's getting into historic downturns.
Yep.
But we have not started to see the readjustment in the underlying economy. We're still way too reliant on housing. We're still way too reliant on residential investment, I would argue on consumer spending here. And to me, that this is going to be a multi-year story of just this economy readjusting. So I still think that looks good. The other one that I think looks good is the Atlantic provinces. I just think work from home's been an enormous boom from them. They're still relatively affordable. They're still seeing strong inflows from other provinces. I think it looks good. And I think Saskatchewan's kind of a sleeper. When I look at that area, like inventory levels are falling. Like there's very little resale inventory. There's very little in the construction pipeline. It's still super affordable relative to the rest of the country. So like, I think you could make a bullish case for Alberta, Saskatchewan, the Atlantic provinces, and Ontario and BC. I hate to say it, are probably in for a bit of a tough slog.
Yeah, well said. We're going to pause right there. We'll be right back, so stay with us.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth Podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Thanks for staying with us. We're back with our special guest, Ben Rabidoux. So what about fraud, underwriting, banks, and kind of how they're assessing refi valuations currently? Any thoughts there, insights?
Well, the only thing I would say is we've gotten some recognition from the federal government that mortgage document fraud is actually a real issue, like a very meaningful issue. And look, I consider that a bit of a small victory. I think I was probably one of the original people kind of pounding the table on this being a much bigger issue than people realize. This was like pre-Home Capital fiasco days.
Yep.
And now you've got the federal government coming out and saying like, look, we need to examine direct linkages between CRA because mortgage document fraud is a big issue. And it's shocking to me that, so, I submitted a budget consultation piece and testified in some of their consultations, and alongside me were representatives from Mortgage Professionals Canada. So this is the industry group representing the mortgage lobby, or the lobby group in the mortgage industry. And in their consultation, they suggested that we need that direct income verification from CRA because fraud had become such an issue. I don't remember a time ever where an industry group is begging the government for more regulation. Like, to me, that tells you everything you need to know about how big a problem that is. And so, like, here's the way to think about it. It's a simple fix, right? The banks, any lender, when they're doing a mortgage application, you have to give them your income documents. They have it already. It's not a privacy issue. Line 15,000 of your notice of assessment, they enter it into a box with CRA, and CRA says yes or no. That's it. It's just, yes, it's accurate. No, it's not. And we've had this in the US for, 20 years, direct income verification. There's no reason not to have it here in Canada. And I think what's going to happen is when they bring that in, and they will, it may not be till next year, but it's coming. I think that is going to be a much bigger form of credit tightening than people recognize. It's like a shadow credit tightening because it's really hard to bypass that on the fraud side.
Correct.
And so, it's going to hurt certain areas more than others, but it's hard not to see that being kind of like a sleeper credit tightening that no one's really thinking about.
Gotcha. So we've got clients across Canada, and the focus of our clientele is folks with 10 million plus and 25 million plus net worths, all the way up to multi-billion in asset levels. So they're thinking a lot of times, okay, how does this translate to the investment markets? Like, where's the opportunities that will be coming? So I know you're not a financial advisor, Ben, and this will be a personal question to you more than a professional question, but just curious your thoughts on bank stocks, bonds. You've already commented about the Canadian dollar likely weakening, which again, I would definitely agree with there. Real return bonds, I think, is an area that we've talked about before, even foreign investment. So how would you kind of just give your personal thoughts on, the aspects of the different markets right now?
Yeah, so I'll comment on a few of those. So I think broadly, the way I'm doing it is just we're entering into a period where we're going to have higher inflation for longer. And not to say that we're going, hyperinflation or anything crazy like that, but we talked offline about something that you didn't even realize, right? And I think most people don't realize this. The government of Canada very quietly scrapped their real return bond issuances. And to me, that's telling. That I think there's a major signal in that, right? And of course, for the listeners, real return bonds are bonds that have an inflation protection that are linked directly to official CPI.
Yep.
And I think the tell in that, this was late last year, the tell there is that they recognize that one of the solutions to this high debt issue that we have in Canada is to allow inflation to run a little hotter for longer. And I think we're getting close to the point where central banks globally, you start to see a trend where they start saying, okay, we've had a 2% target, but maybe 3% is good enough, right? And you start seeing this kind of shift towards, well, maybe that's close enough because you're going to have to let that inflation run a little hotter. And of course, that's not an environment where you want to have your liabilities pegged to inflation. And so, if you have that view, it makes perfect sense why the Bank Canada would shelve any future real return bond offerings. And so, yeah, I think that's interesting. That's interesting from a fixed income perspective, because now you're dealing with a shrinking pool of assets. And arguably we're going to be getting into a time where those become more in demand. So I like that. I've commented already on, I think Canadian dollar is going to go considerably lower vis-a-vis the US dollar. And so I do like having assets denominated in US dollars. I think, look, I'm still quite constructive on just broadly the energy, real asset type play. Anything that's not highly levered, that has good cash flow at current rates, I think is super attractive. And, I also like, we talked a little bit about just this kind of secular theme around the US trying to move supply chain away from China and more towards friendlier jurisdictions. And I think a lot of that's going to benefit Mexico. So I think there's probably like a more of a structural tailwind there. So, I mean, there's interesting ideas around that. It relates to Canada. I like the natural resource plays. You probably guess I'm not like as fired up about the banks. I just think they're kind of black boxes that are going to just have a lot of headwinds for a long time. as we go through a credit cycle, and then you have to understand the way that regulators typically work is after you've gone through a credit cycle, then they layer on all of these regulations that just hinder their ability to make money for a decade, right? And you see this over and over and over again. And I don't know that it's going to be that different here in Canada. So I'm not as bullish on Canadian banks. I'm going to own financials. There's probably a lot of other places I'd want to look.
Gotcha. So playing this out a little bit, if the Canadian dollar does drop, it makes Canadian companies cheaper from an acquisition point of view. So I would probably say in some pockets, there could be some increased M&A or mergers and acquisitions from the U.S. and some global buyers of Canadian assets. So there could be a bit of an offset there, I think, overall.
Well, and I also think, Thane, just to add to that, I think any company that produces things that are priced in U.S. dollars is going to look really good. So, I mean, I would say that look at some of the energy companies. I mean, if you look at what that's going to mean, if you assume that crude prices have a bit of a floor, and that's a big assumption, but let's say that prices stay here, okay, and the Canadian dollar drops to the low 60s, let's say, these companies are going to just gush cash. I mean, a number of them. So, I mean, there's an interesting way to kind of protect from that. You don't need the direct U.S. dollar exposure. You can own Canadian dollar companies that are selling commodities in U.S. dollars and are already trading at today's levels, mid-teen free cash flow yields, assuming oil kind of in this range, right? And that's, not even getting into it. Look, the other thing is you get a conservative government come in 25, like these things re-rate dramatically, I think, right? Because now all of a sudden you've got to, you remove this kind of this cloud that hangs over them around excess profit taxes and all the other crap that the government's talked about, just trying to weigh on this sector. And you get TMX starting to fill. Like I just think there's a lot of positive tailwinds for the energy sector in Canada. So I really like that, to be honest.
So I'm going to give you the opportunity now to kind of wrap things up with 2 or 3 takeaways from this call and from your current thinking, your current research of your firm. What would be the 2 or 3 key things you'd want people really paying attention to going forward from here?
Really paying attention. I think really need to watch what's happening with resale market inventory. I commented on it earlier, but up until the last 2 months, inventory levels have been fairly low. We're starting to see a pretty significant inventory build, and if that continues, this market's gonna change, right? I think you're gonna start seeing downward price pressure again come the summer if these inventory trends continue. So that's a big one. But in terms of just broad takeaways, I still just think that the market is underpricing the risk of just a hard landing in Canada and what that's going to mean for rates. And I think this idea that there's going to be this gentle drift lower in rates and 50 basis points this year, to me, it's going to be all or nothing. Like by the time that the Bank of Canada has to start cutting rates, I think the wheels have come off, and at that point, typically it takes a couple hundred basis points of cuts to start to put a floor under things. And I don't think there's a huge view around how this is likely going to play out, in the sense that it's either going to be rates are kind of hanging out where they are currently, or they're going to be a lot lower. You know what I mean? It's probably not the middle ground where they just kind of slowly, gently drift. And I would bank on them being quite a bit lower.
Interesting. So I'll give you a third shot here, and that is your website, corporate website, if you want to mention it.
Yeah, I don't have much of a website for North Cove Advisors. Everything is actually word of mouth. So all of my clients have always found me from word of mouth from other clients. But you can reach out to me, ben@northcove.net. If you're in the real estate space, so realtor, developer, mortgage broker, insolvency trustee, anyone remotely connected to that, you can check out edgeanalytics.ca, which is an offering that takes that institutional quality research, but then makes it more accessible for folks in the real estate space. And then the side effect for that is I get to build out this interesting network of people and kind of collect anecdotes, touch base, and find out from them what's happening. And that in turn informs my views for my institutional clients. It's kind of a nice little flywheel.
Excellent. Well, thanks, Ben. I really appreciate your time today and some very good insights as usual. And thanks for keeping us posted and our listeners and viewers. And with that in mind, have a great day. And thanks once again for making the time. Appreciate it.
Of course, Thane, anytime.
All right. Thanks again. Well, thanks. That was Ben Rabidoux, founder of North Cove Advisors, the boutique research firm that's consistently ranked top 5 in institutional research. On our next episode, I get to chat with Judy Cunningham, founder of a company called Trella, a firm that helps multi-generational families, family enterprises grow and evolve. Stay tuned for that next month. We hope that you're enjoying our monthly podcast episodes, which are produced by the great, amazing BNN Bloomberg brand studio team in partnership with Stenner Wealth Partners and CG Wealth Management. Again, I'm Thane Stenner, and thanks for listening in on our monthly Smart Wealth podcast. See you next month.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF. The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.